Chinese bank ICBC, the world's biggest lender by assets, hit by a cyber attack, leaving traders and brokers alike scrambling. So let's take a quick look at the European markets map here, because look, a lot of cross currents, a couple of earnings misses that are dragging down the stock 600. You're really seeing that with the red on the screen right here. Take a look at that underperformance from the CAC 40, down about 0.8%. But even right here in the UK, also down by about the same margin. So really seeing some pain across Europe. You do have on some of the kind of the outskirts a little bit of outperformance, but that's really a function of light liquidity, light volume, not much trading. But when you're talking about the earnings stories that we just highlighted, and we're going to be diving in throughout the show, that's where the pain exists. In addition to this macro environment of simply what does a more hawkish Federal Reserve look like? Maybe that dovish pit the markets were pricing in isn't actually at play, and that creates a little bit of a pullback around the world, as we said. I want to get to, of course, those very comments. He spoke at an IMF conference in Washington. Fed Chair Jerome Powell saying that the U.S. Central Bank will continue to move carefully in its bid to tame inflation. The Federal Reserve did not, however, take the possibility of future hikes off the table.
If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening.
Joining us for more, Charlotte Ryland, Head of Investments at CCLA Investment Management. She joins me right here on set. Charlotte, a pleasure to have you, as always. Let's talk about these comments from Chair Powell first. The initial take, is this simply him just walking back the market interpretation of the FOMC? Is this as simple as that?
I mean, I think the market's got itself terribly excited, having had that most of October being very depressed and saying high rates for longer. Then, you seem to sort of say, actually, maybe some of the employment data suggesting perhaps we might be moving back into cuts again. So I think this is just him saying, look, we'll make sure we carry on in this battle. If we need to raise rates, if inflation did pick up again, then we would be doing that. But I don't think it's a sort of a major shift in change.
There was some commentary coming out of JP Morgan as well that simply a lot of the market reaction here is basically stuck between a rock and a hard place. That being, on the one hand, this Treasury issuance that we're seeing a really poor auction overnight in the U.S. relative to some sort of deceleration in the economy that speeds up. What's the bigger issue for you?
I think for us it is about, do we go into recession? That's obviously been the big debate all year. We started off in January and there was consensus that it's going to be a recession. Clearly the US economy has been much stronger than people had been anticipating. But I think some of those headwinds are still there as we move into 2024. I mean, in terms of sort of those COVID savings that people were sitting on, in terms of the impact of higher interest rates and the lags that has. And there are some signs of weakness in things like the labour market. So it's generally been a pretty benign economy, but that continues to be sort of the big debate, I think, as we move into next year.
Well, when we talk about the weakness in the labour market, and we saw this kind of in the corporate side as well, that because of these really weird cross-currents in the labour markets, these changes in the wages dynamic, it started eating into corporate profits, and then by extension, the amount of investment that you could see on an economic level as well. Is the labour market still the issue here, or are we now going back to this core principle of confusion in terms of whether or not resilience is a positive or a negative thing?
Yes, exactly. It's good news on the economy, bad news because we get rates moving up. I mean, I think generally it's been a labour market which obviously got very disrupted by COVID. Participation rates have moved back up for most parts of the labour market, possibly not that sort of over 55 age group. So that has improved. I mean, if you look at Europe, obviously a slightly more complicated picture, particularly in the UK with Brexit and the implications that has had in terms of immigration, etc. But I think that labour market, having been extremely tight, there are some signs that that's beginning to loosen off a little bit, but certainly not a difficult situation yet.
Well, I think what was so striking to me is when we've heard in the last, I want to say 3 weeks or so, we've heard it from the BOE, the ECB, the Fed, and then the BOJ. But it was the BOJ, don't worry, I won't ask you about Japan, but the BOJ commentary was really interesting to me because in his press conference, Ueda actively mentioned not only the wage dynamics in the United States, but he mentioned the Treasury sell-off in the United States as well, as in driving some of the market action in JGBs. And to you, my question is, do you start to see those same issues on the U.S. economy somehow feeding into the monetary policy thinking of the BOE and the ECB?
I mean, I think the UK and was slightly better than perhaps people expected this morning, but still not exactly great. So I think, but equally in the UK, we have a much bigger problem in terms of inflation, and that still hasn't pulled back into the same extent you've seen within the US. But yes, what happens in the US clearly drives the rest of the world economy, and what the Fed does will clearly have big influence too.
Yeah, the macro really putting a lot of pressure on the margin story as well on a corporate level. Charlotte Ryland of CCLA Investment Management, she is staying with us. We're not letting her go just yet, but it's that margin story I want to focus in on for a moment. I want to get the latest on two disappointing earnings reports, starting with Diageo. Shares slumping after it warned of a pretty steep slowdown in its Latin American and Caribbean division. And in the meantime, Richemont as well, the massive luxury maker, seeing sales of Swiss watches decline. Who better to dive into all of this than Bloomberg's Andrea Felstead? She joins me from Bloomberg Opinion right here on set. Good morning, Andrea. Let's start a little bit about the broader luxury market here. Is Richemont's report indicative of what we're seeing in the broader sector?
Yes, definitely. It's the latest luxury group to say that we are seeing a slowdown from the very strong demands that we saw during the pandemic when consumers spent their lockdown savings, their stimulus payments on Cartier watches, Alea handbags. Those factors are now reversing and they are pulling back. Plus, the Chinese consumer is being much more cautious than many people expected.
At the same time, when we think luxury, I think simply because of that kind of deceleration you've seen for a while, I feel like it's been on both sides of the Atlantic. There's a question of M&A, and in the U.S. we've seen a lot of M&A, Tapestry, Coach, etc. In the U.S., in the U.K. and in Europe, we've seen a similar kind of thread with Valentino, with Kering, and some of the trades there as well. There was a lot of speculation about Richemont's role in the M&A space. Now we know that they're selling a stake of YNAB to Farfetch. Is that still on track? Is that still a good idea?
It looks like it. It looks like it is on track. It's a good idea for Richemont. They want to get the losses from YNAB off of their balance sheet. The problem is Farfetch is having a very hard time at the moment. The slowdown in online and aspirational luxury has really hit it. It's got a lot of debt. The worry in the market is that if Richemont wants to carry on with this deal, it is going to have to support Farfetch in some way. That's exactly the opposite of what it wanted to do by selling a stake in YNAB.
I don't know how to make an elegant pivot here, so I'm going to try. When we talk about luxury, I guess we talk about spirits as well. Let's talk about Diageo.
Exactly. You're exactly right. Diageo has felt some of the same effects as the luxury industry in the US, because it's those aspirational consumers. They were spending on luxury. They were also going out when they could and spent on pricey tequila and spirits. That's unwinding. But what has caught Diageo
meant to in the first place? Bloomberg Opinion's Andrea Felstead, we thank you so much for dropping some insight on those two major earnings stories. And like she said, earnings season is in full swing. You are seeing this demand pullback. Let's get back to Charlotte Ryland, bring back in the macro. She's the head of investments at CCLA Investment Management. Look, we've talked about this margin story. Andrea just did a beautiful job of talking about this demand story in the United States as well. Recession has been a conversation 3 years now, 3.5 years now. This feels like an old conversation to have. Is recession the solution to kind of the risk of zombification of economies around the world?
I mean, I think, you know, the confusion we've had some parts of the economy really slowing down, so particularly the sort of durable goods area, manufacturing has definitely had a slowdown. But the services part of the economy has continued to grow very strongly, and part of that, you know, that sort of COVID overhang. Yes, people have been going out buying LVMH handbags, but they've also been going on holidays. Travellers had a great year. Restaurants have had a reasonably good year. So, I mean, that's been that sort of dynamic, that sort of mixture has been going on. And so, you know, I suppose the question as we move into next year is, does some of that begin to slow down? But equally, you could have things like manufacturing beginning to pick up again.
I mean, we're talking a lot about manufacturing. I want to come back to the financial side of the equation, the consumer confidence specifically. In the U.S. at 10 a.m. U.S. time, we get consumer confidence data as well. And we've been talking as well as a lot about the Chinese consumer. And I'm curious how much the consumer is really driving any increase in the global economy that you're seeing, as opposed to it being more production and corporate-led.
I mean, I suppose the stats always tend to look on that manufacturing side, but the US economy is predominantly about the consumer, and that consumer has, despite, you know, the rise in sort of living costs, has been doing reasonably well. China, of course, is in a much more difficult situation. You've had that very prolonged COVID lockdown, which definitely has affected sentiment, and you've got their property market in all kinds of trouble. Now, that's not ended up being a sort of US-style collapse that we saw sort of 2007 kind of levels, but it certainly must be a drag on consumer sentiment. That's your major sort of savings pot, I suppose, is those property markets. So those are slowing that's difficult. And you add into that, you know, youth unemployment is not great either. So that Chinese consumer has not bounced back in the way that people had hoped this year, but it still continues to be sort of a longer-term, you know, driver potentially.
I'm old enough to remember pre-COVID when Chinese data mattered more for the economy, exports, trade deficits, et cetera. And it feels like, to some extent, it held that role when it comes to European luxury. Andrea Felstead kind of talked about where the slowdown is coming from. Is China still relevant to the rest of the economy when some of those trade relationships are deteriorating, when they have this kind of post-COVID policy where the Chinese consumer may mean less to the global economy?
I mean, I think around the edges, clearly we are beginning to shift away from China as the manufacturing hub of the world, but it is still that manufacturing hub. It is still a market of over 1 billion consumers whose levels of wealth has increased massively over the last 20 years. So it is still, you know, a really important market. Yes, it's not growing at the same levels that we saw before, and we've seen companies like Estée Lauder, for example, you know, really struggling in the Chinese market over the last year or so. But is it still going to be a really important market for all of those companies? Yes, it is.
When talking about, I'm going to bring it back to monetary policy as well. And it feels like when you look at some of the data coming out of China, specifically from the PBOC, from the liquidity reserves, from the FX story as well, this idea that perhaps demand for more safer assets like treasuries, for example, is deteriorating. This is a much longer term story. We're talking about fiscal deficits, et cetera, et cetera. Does that matter for the short term story that this de-dollarization narrative exists, this like exposing yourself to treasuries exists from Asia, from pieces of the Middle East? Does that matter to your investor playbook?
I think round the edges, and I think the thing with the bond market is it is now at levels where it's actually investable again. Having been for many years, the yields were so low, it just wasn't a sensible place to be. You should be in other risk assets. Now actually is a reasonable place, you know, if you compare that to, say, you know, REITs, or you compare it to some of those sort of safe alternative assets.
So you would buy at 5% to your yield?
Possibly so. Yeah, I mean, I think our view is that we've probably come to the peak of rates, short of another inflation shock.
Yeah.
And so therefore, we've actually got a little bit of value on the table in terms of bonds. So, you know, I think it's part of portfolios again.
The juicy real yield making an appearance. Charlotte Ryland, Head of Investments at CCLA Investment Management, we thank you so much for joining the program. Coming up, the UK economy flatlined in the third quarter as higher interest rates took their toll. We look at the numbers next. Stick with us. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet.